We've had a bunch of people criticizing the Fitch downgrade of the U.S. credit, and it seemed like there was one odd man out. The big two rating agencies are S&P and Moody's. Fitch is kind of the third. They're technically the big three. Fitch people will tell you it's the big three. Maybe S&P and Moody's will tell you it's the big two or whatever. Doesn't matter. These are the big three credit rating agencies. And Moody's was the one player who hasn't downgraded the U.S. credit. But what they did today was downgrade U.S. banks, essentially, and say they might do more downgrading of U.S. banks. This is not some sort of positive thing, some good thing. It might be good for JP Morgan. JP Morgan's making a tremendous amount of money. They've been expecting a difficult situation to occur. But clearly Moody's is not trying to fight against this idea. So maybe we need to give some validity to this credit downgrade, to the idea that there might be a broader deleveraging in the economy. And this might become forced upon us if a recession does occur and incomes begin to drop. That is going to be the nail in the coffin. Does the contraction of money supply lead to just general incomes dropping? Certainly possible. Certainly possible. We know credit is contracting. Credit is as good as printed money, so that is coming down. That's, I guess, supposedly as good as shredded money. So there are definitely signs out there. Obviously, we talked about the recessionary signs. Today, we're kind of just talking about a little bit more about the financial signs. But things are interesting. China is absolutely getting clobbered, it looks like. I mean, these are double-digit import and export decline numbers. That's big. Like, hello. Global slowdown upon us. That's what it seems like. I don't know what's keeping U.S. GDP so strong. Haven't been able to figure that out. It's obviously some form of government spending, whether that be defense or these factory buildings, which are, I think, we're going to have a lot of vacant factories because PMIs are coming down and things are just going to be very interesting. So I'm obviously not super optimistic on the economy. I think the market's gotten quite exuberant. I think money has contracted. I think interest rates have gone up, and I think we're very close to all-time highs, even after these several days of consecutive, or close to consecutive pullback. So I think patience is warranted. I think being defensive is warranted. I think having cash is warranted. And if there is a time to go short, I think it was, a week or so ago. I'm positioned in a way and expecting such that this coming CPI will be cool. But I also expect, finally, a reacceleration in inflation. We saw oil pull back aggressively today, 2% plus, on this Moody's downgrade, on the China numbers. And then we just saw that be very clearly paper traders as the market more than recovered its losses. So things are weird. Things have been weird. But in my thoughts, if you look at the signs holistically and don't look at things so up close, such, here and there kind of things. We're talking about an earnings report, a CPI report. If we look at more where we are in the economic cycle, the forces that cause the economic cycle to turn, balance sheets of things like governments, the implications of that for how they raise future revenues, we get a little bit more concerned. And obviously oil prices, the biggest deficit we've had in a very, very, very long time. Bigger than at any point last year. And we're seeing that in the strength today. So today's video is a little shorter than yesterday's. If you haven't watched yesterday's, I highly recommend it. We go over the recession. This video is recorded on the presumption that you would watch yesterday's video and adding to that. So that's today's video. And until next time, peace out.